to have you on the show. I know your expertise really comes to retirement. So for anyone who is looking at their 401k, concerned perhaps about the recent volatility that we've seen in the market, what would you tell them?
Kristen, it's great to be with you. Really, we're seeing two things. We see everything going on, of course, right now with economic policy. This has to do with all the discussion about tariffs and taxes, and again, new economic policy. And the market's weighing that out with, of course, what the Fed's doing with fiscal policy. And it's driving a lot of the, moves we've seen in the market. The market hates uncertainty. So a lot of what has caused the volatility the first part of the year here has been the market really trying to gain clarity on what ultimately is going to happen with things like tariffs. And I think now we are starting to see some clarity. Obviously, we've heard, so many times the negotiation tactic, with the tariffs citing, big, huge tariffs on Canada and Mexico. But in all reality, Trump has cited this sort of D-Day, Liberation Day, if you will. And really what it's coming down to is it looks like there's going to be about 15 countries that actually have tariffs associated with them. It's not going to be these huge sector-wide moves yet. And the market's seeming to like that.
Mm-hmm. So for people who are looking at their 401k, should they adjust their investment strategy, or you think continue to focus on the long term?
Well, of course, it's always important to invest, especially in retirement, with a long-term view. Now, that said, I do have my eye very much on what Jerome Powell is going to do next. I was really interested to see the comments last week. It almost is as if he doesn't want to play ball with the Treasury. Scott Bessent has said, several times now, we need to refinance a ton of this debt. There's political pressure to lower rates, and I think even societal pressure to lower rates. And so to see Powell only note that they look at another maybe 2 decreases throughout this year does make me a little bit concerned about what, second order effects that's going to have in the economy when we also saw the Fed revise their, GDP growth number down and, increase their inflation estimate for the year.
Let's talk about the consumer, Ted, because that really is at the crux of the economy. 70% of overall GDP growth. Believe it or not, this week we'll actually get 2 reads on the consumer, one coming at 10 a.m. Eastern today. That's consumer confidence, consumer sentiment at the end of the week, and a second revision on fourth quarter GDP. That'll be on Thursday. Does this impact this environment with the Fed chair noting more uncertainty? Does it impact consumer spending and thus the economy?
Of course, really interestingly, I think the consumer sentiment and confidence has actually been dropping down, and we'll see what it comes out to today. A lot of estimates estimate another dip below where it was. I think it was 98, the last print we got. And so, at the end of the day, I think, normal people are trying to ask themselves, do I have access to the American dream? Are my wages durable? Are they going to fight that inflation? And secondly, can I access the housing market, which is kind of what I was saying before? I think there's societal pressure to see rates come down too, especially on that latter piece. Housing is a huge part of, that American dream. And so it's really hard to see, progress toward a belief in consumer confidence if that seems out of reach.
I do want to show an image of your book, Ted, to give our viewers a good visual sense here as to what you cover when it comes to retirement. And my question there is, of course, obviously, what stage you are in your life, I think does matter, as you might say, of course, in terms of what you should be thinking about in this environment when it comes to retirement. What are the tiers or maybe ages where people should think about in a market that is a little bit uncertain, that maybe they should be making some adjustments?
I think one of the key age ranges we really start to zoom in on is when you hit that 65 mark. And of course, everyone cites 65 as a, retirement date. It's when we start Medicare. So a lot of folks retire around 65 to 67 these days. If you back out just about 5 years from that point that you plan to retire, we really need to start being proactive with the type of adjustments you think about on your portfolio. We want to make sure as you hit that 5-year window, you have enough money set aside that is safer. So we're thinking maybe short-term bonds in a market like this, maybe some medium term, and definitely cash. Cash is still paying really good. And so we want to think about your overall risk coming down a little bit, especially as you hit that 5-year window, and making sure you have enough cash set aside to cover those, more urgent potential needs. And make sure you don't get derailed if there is some market volatility.
Yes. Anything else you would recommend in this environment, Ted?
I do think that with the overall belief that over time Fed rates will come down, I think that, and even pairing that with the tariff likelihoods here, I think we've been looking a lot more at those small cap positions. A lowering rate environment is going to be a tailwind for those type of holdings sector wide against small cap. And, small cap tends to be more domestic in nature. And so if there are going to be, more significant tariffs potentially coming, that's going to generally benefit those more domestic companies as well.
Ted Thatcher, president at Bright Lake Wealth Management. Ted, thank you so much for joining.